In Chapter 3, we'll be discussing items that relate to what we include in income and what we don't include. And those income and exclusions then will be the primary topics that we'll be discussing in this chapter. However, we'll also be discussing some a little bit more complicated issues, especially related to the recognition of Social Security benefits and the extent to which they may be recognized. So I'll go through some problems as we proceed in this video and the next, and we'll fill out some of the details on how to calculate the provisional income that relates to Social Security benefits, as well as to determine whether or not any portion of those benefits may be taxable. So to begin with, let's start with some of the fundamental concepts then of incomes and inclusions of taxation. So when we think about income in the context of taxation, it is very similar to that which you would use for accounting purposes. That is, income has to be realized and earned. However, there are some additional conditions that need to be met for tax purposes. That is, there has to be a discernible economic benefit of the transaction. There has to be a conclusion to the transaction. And then the income from the transaction must not be tax exempt. For example, if the income is from municipal bonds, then that income is tax exempt for federal tax purposes and therefore would not qualify as taxable income. So, as we know, the IRS is biased for individuals toward cash flow, and so most individuals file their tax returns on a near cash basis. And we'll talk a little bit more about what that cash flow entails in this brief video. And then we'll also talk about this concept of constructive receipt. That is to say, maybe you haven't received the cash yet, or the property at fair market value, but you have an irreversible right to that income and that you have control over that income. Other kinds of income then, besides earned income, are interest from banks and S&Ls, credit unions as well, and you'll receive a 1099 INT that indicates the amount of interest that you've earned. Interest on federally issued Series E and EE savings bonds are taxable, but the taxpayer can elect to almost treat this as an accrual type income recognition, and they can recognize the increase in the bond, for example, gradually until the bond matures, rather than waiting until the end and then recognizing all the income at full maturity. Other kinds of interest then that would be subject to taxation is if you, for example, you sell your house and you finance the loan to the buyer, and the buyer starts making payments, the interest component of those payments is income and would have to be reported. Other examples, as you see listed, receipts from installment sales. Imputed interest on loans made at below market interest rates. What we mean by imputed interest is that if, for example, someone loans money to someone at below what they would pay in an arm's length or unbiased transaction, then that the difference between those two means that this favoritism has to be accommodated in the tax code, and they did this by this imputed interest rule that says we are going to, even though you're charging 2%, the going market rate is 4%, so we're going to impute that as the interest rate, whether you've received it or not. That we're going to impute that as taxable income to you. Interest on bonds sold between interest dates is also taxable income. If you receive interest and dividends, for that matter, in excess of $1,500, then the taxpayer needs to complete Schedule B of Form 1040 to report those interest and dividends. So dividends these are distributions to shareholders, generally out of the earnings and profits, either current or previous or accumulated earnings and profits of the corporation. So earnings and profits is a new term to us, And earnings and profits is very similar to the concept of retained earnings on the financial accounting side. So the two concepts are very similar, but in the tax code we use the term earnings and profits, or E&P. I mentioned earlier that dividends are treated very similarly to interest, and that is if we record, in terms of these thresholds, I should say, only in terms of these thresholds. In terms of the taxability of interest and dividends, the tax code treats them very differently. For example, interest received is taxed at your ordinary marginal tax rate, but dividends are taxed at the preferential capital gains tax rates, which we'll talk about later in the course. If, for example, the taxpayer receives a refund from the state, the question is, does that refund from the state from last year's taxes, does that qualify as income that must be reported this year? And the answer is, well, it depends. If, for example, last year the taxpayer did not itemize but took the standard deduction, then no, none of the refund from the state this year would be taxable. However, if the taxpayer did itemize last year, then all or a portion of that refund may be taxable. I mentioned at the outset that Social Security benefits could be taxable. It depends upon the tax position of the taxpayer, and we'll talk more about that. And I think the best way to go through this little bit more complex issue is to demonstrate it by running through some problems, and we'll do that either in this video or the next. The first step that we're going to be talking about that we need to go through when we try to determine if Social Security benefits are taxable is we need to determine provisional income. And this is called MAGI, or Modified Adjusted Gross Income. So we need to first determine the modified AGI, and then we'll use that to compare to thresholds that we use that initiates the process of determining whether or not those Social Security benefits may be taxable. So what is provisional income? Provisional income is the income where we start with our adjusted gross income before we consider any Social Security benefits. And then we're going to start adding back some things that we've excluded before. And again, this calculation is just used, in this case, within the context of determining provisional income, which is required for determining the taxability or potential taxability of Social Security benefits. So we'll start with AGI, adjusted gross income, and then we'll add back interest on U.S. savings bond that we might have excluded for educational purposes, most tax-exempt interest, for example, in municipal bonds, any employer-provided adoption benefits that normally are not taxable. Well, for purposes of determining taxability of Social Security benefits, we add those back, as we do with excluded foreign income, deducted interest on educational loans, and then deducted tuition and fees. Also, we're going to add back 50% of the Social Security benefits that the taxpayer received that year. So these are adjustments we make to AGI to get to this provisional income threshold. And then if this provisional income threshold that we just calculated exceeds certain levels depending upon our filing status, then up 50% or up to 85% of those Social Security benefits may be taxable. In the next video, we'll continue our conversation about Chapter 3.